There's a number that doesn't exist. Not in any vault, not in any account, not anywhere you can actually point to. But if enough people stop believing in it, the entire financial system collapses in about 48 hours. That number is $18 trillion. And it's moving right now through systems that assume it will always be there when someone asks for it. Which is fine, until everyone asks at the same time. This is the story of how money works when you zoom out far enough to see the cracks. Let's start with something simple. You put $1,000 in your bank account. You check your balance, it says $1,000. You feel good. The money's there. Except it's not. The bank took your $1,000 about 11 seconds after you deposited it and lent it to someone buying a car. That person's dealer deposited it in their bank, which lent 90% of it to someone buying a house. That person's seller deposited it in their bank, which lent most of it to a business buying equipment. Your $1,000 just became $4,000 in the economy. Same money, counted 4 times. And all 4 people think they have access to it. This is called fractional reserve banking, and it's not a secret. It's just that most people never think about what happens when the music stops. The dangerous assumption is this: not everyone will want their money at the same time. It's a good assumption. Statistically, it holds. On any given Tuesday, 97% of depositors leave their money exactly where it is. The system hums along, banks keep about 10% in reserve, lend out the rest, and everyone's balance looks solid. But that 3%, that's the gap the entire economy is built over. In 2008, that gap opened. Not everywhere at once, just in a few places. Lehman Brothers, a bank that had survived the Civil War, the Great Depression, and 2 world wars, collapsed in less than a week once people stopped believing the numbers on their balance sheet were real. The problem wasn't that Lehman ran out of assets. They had plenty: buildings, bonds, contracts worth billions. The problem was they needed cash right then, and all those billions were tied up in things that take time to sell. Liquidity versus solvency. 2 words that sound boring until you realize the difference can end civilization. The $18 trillion I mentioned earlier, that's the amount moving through the US financial system every single day. Most of it is invisible. Repo markets, overnight loans, collateral swaps between institutions you've never heard of. It's the circulatory system of modern finance, and it runs on a piece of infrastructure called the Fedwire, which processes about 4 trillion a day, and clearinghouse interbank payment system, which does another 2 trillion. These systems are basically digital hallways where IOUs get passed back and forth at the speed of light, and everyone assumes the IOU they receive is as good as the cash they just sent. Here's the uncomfortable part. There are about $2 trillion of actual reserves in the entire banking system to back up 18 trillion in daily flows. It works because of timing, because of trust, because of the assumption that the Federal Reserve will step in if anything breaks. That assumption was tested in September 2019, and most people didn't even notice. The repo market froze. Overnight lending rates, which are supposed to stay around 2%, spiked to 10% in a matter of hours. Banks that lend to each other every single day without thinking about it suddenly stopped. Not because they were insolvent, because they weren't sure everyone else was solvent. The Fed had to inject hundreds of billions of dollars into the system just to keep it moving. They called it a technical issue. They said it was temporary, but it revealed something important. The assumption only holds if nobody questions it. The absurd part is that this isn't even a flaw. It's a feature. Fractional reserve banking, leverage, liquidity mismatches, all of it exists because it's efficient. It turns $1 into 4. It funds mortgages and businesses and infrastructure without requiring someone to physically hold all the cash in a room somewhere. It works beautifully right up until the moment it doesn't. And when it doesn't, we find out that the safety net is also based on an assumption that the central bank can print enough money fast enough to convince everyone the system is still solid. Which brings us to the next question nobody wants to ask out loud. What happens when the central bank itself is the thing people stop believing in? In 2008, the Fed's balance sheet was under $1 trillion. Today, it's over 7 trillion. That's not money they had. That's money they created electronically to buy bonds and stabilize markets. It worked. Markets stabilized. The system survived. But every time we do this, the gap between the real economy and the financial economy gets wider. More money chasing the same assets. More debt propping up more debt. More assumptions stacked on top of other assumptions. And somewhere in that stack is the assumption we started with, that not everyone will ask for their money at the same time. So here's the thing about assumptions. They're invisible until they're not. The financial system runs on trust, on credit, on the belief that tomorrow will look enough like today, that all the numbers will keep making sense. And maybe they will, but $18 trillion a day is a lot of faith to put in a system held together by $2 trillion in reserves and the hope that nobody panics. The money's not really there. It never was. The question is, how long until enough people notice?